Okay, we're going to go ahead and get started. Just a quick announcement to my students. When this is over, we're going to have a quick, maybe 10-minute break, and then we will reconvene in the Dean's Conference Room. So down at the end of the hall, the room with the windows that we liked but can't always get. So we'll meet down there. So this will go probably until about 1:15. We'll take a break and reconvene at 1:30. Okay? So it is my great pleasure today to introduce my good friend and colleague, Mark Blyth. Mark is a professor of international political economy at Brown University and the Watson Institute. New to Brown since 2009. Before that, you were how many years at Johns Hopkins?
Too many.
Too many years at Johns Hopkins in Baltimore. His PhD is in political science from Columbia University. And even though he's trained in international relations, he's a man of many hats. He's been employed as a comparativist. He has been offered jobs in American politics, and even has taught graduate political level theory courses. He also has a large fan club in France and has been featured in economics journals there. So it's very rare for a political scientist to have an economist fan club. Usually it's the other way around. And the theme that ties all of his work together in his own words is his fascination with how humans cope with uncertainty, particularly in economic life. So he has many publications to his record. His big book is called Great Transformations: Economic Ideas and Political Change in the 20th Century. That's from Cambridge University Press. Got a great cartoon at the front. More recently, he edited the Handbook of International Political Economy, which as soon as it goes to paperback is soon to be the bestseller, I think, in the field. And also co-edits with Craig Parsons and Rawi Abdullah, Constructing the International Economy, one of the first constructivist IPE books in the discipline. He's also written articles in all the major political science journals, including American Political Science Review, World Politics, International Studies Quarterly, and what he calls the rest of the usual suspects. Perhaps more interestingly, he's also published a piece on the movie The Matrix. He's edited a book on school districts and U.S. big cities, despite being Scottish. And he has published a piece in 2002 that said the use of internal risk models by banks will probably blow up the world at some point. 2002 he said that. Very impressive. So currently Mark is also a member of the Anglo-German Warwick Commission on Financial Reform, which has a big report due out this month about the financial crisis. And he's also currently writing a book called The End of the Liberal World. And this book charts how finance became a major component of GDP in advanced economies and why this might not be such a great idea. So I've asked Mark to basically give us today a primer of the current financial crisis, causes, consequences, and possibly solutions. And so this is sort of pitched at a broad overview level, but we will have time for some Q&A. You can ask them for some more pointed questions. So, good enough?
Thank you for that excellent introduction. As you can hear, I'm not from Texas. Kate's heard this gag before, but I will say it again anyway. If you have any problem with my accent, just try and channel Shrek. Because I actually have exactly the same accent as Shrek, and I will prove this now. Donkey! One word, that's it, everyone's tuned in. I also study finance. How do you know I study finance? Because I dress better than 98% of other academics. That's how they get you in the door. Basically, if you say, you're a political economist and you want to interview someone who's like a top banker, they won't go near you. If they find out you look like this, they'll actually talk to you. It's very strange. It's a nice little cultural anthropology. In terms of my own work, the fascination with uncertainty comes from the fact that I'm a Scottish Catholic. That means, unlike Irish Catholics who came to Scotland in the 1870s, we were actually not thrown into the sea in the middle of the 16th century and managed to hang on with our claws. Catholicism and my second love, economics, have something in common, of course, which is uncertainty, and the fact that they both try to tame them with dogma. So, responding to Kate's call to basically give you a what the hell happened, I put together this PowerPoint. I just came back from Norway, where they have a big... Is anybody from Scandinavia? No Scandinavians? They have this amazing thing. You guys will love it as a public policy school. They have this thing called rational policy making. It's totally insane. What they do is they actually get this big council of people together who know stuff about a problem, and then they invite other people who might know stuff too, and they talk about it, and they write a report, and the government actually pays attention. It's totally crazy. Who'd have thought? Here, basically, the policy model that I'm used to is you put a bunch of policy proposals on the masts of small boats, and you put them into a pond, and then a monkey picks them out. And that basically becomes whatever policy is for the next couple of years. So with that in mind, how do we get into this mess? So what actually happened so far? Oh, at the bottom it says, with apologies for some wrong dates on the x-axis. There's a weird thing about the newer version of PowerPoint for Mac, that if you create your file in Excel and then upload it into PowerPoint, all the dates go off by 4 years. So this is going to look like I'm predicting things through the end of 2013. I'm not. It's just a mistake. So I filled in some dates at the top to make this more clear. All right, so what happened? As you all know, there was a housing bubble, and it burst quite spectacularly. Now, that's okay. What happens? Well, there's also stock prices. So basically, there's your DJIA, and there's a decade's worth of appreciation gone. Now, it's gone up again most recently, and it's gone even higher than that data will take you through. Again, that's not 2013, it's 2009. And in the Q&A, I'll be happy to tell you about why there is this bubble going up just, well, I won't say bubble, why there's a rise in the stock market just now, despite the fact that every major economic indicator is going in the other direction, because it is quite an interesting question. At the same time, global share prices fell off a cliff. What happens to America happens to everyone else. In the less developed countries, you have a similar sort of thing. This might be evidence of decoupling towards the end, as you see the major developing economies such as China rebounding much quicker. And again, I'd be happy to talk about this. So why did this happen? Well, because of something that people call a liquidity crunch. So what's a liquidity crunch then? Well, this is what happens when banks freak out and stop lending to each other. So what you're looking at here is an index called the iTraxx, and this is credit default swap protection on firms. So all this stuff sounds really complex, derivatives, blah, blah, blah. It's actually really simple, and it has to be simple because bankers aren't that smart. The people who do the models for them are incredibly smart and are probably the smartest people I've ever met on your planet. Nonetheless, these ones are not that smart, so they like simple indices that can explain things. What does this index actually show? Let's say you're worried about a company failing. Let's say you've got business with 30 or 40 different companies. You're a large multinational. And one of those does a critical component for you. Think Boeing just now with the 787. Well, wouldn't it be nice if you had some way of insuring yourself against the fact that they might screw up and thereby screw your entire supply line? So credit default swaps are actually a really useful instrument. I'll get into the whole thing about if instruments are bad and so on and so forth. I don't think that they actually are. And what this measures is the cost of protection. So essentially, as you see, as you go along the x-axis, it's relatively cheap. Nobody's that worried. Everyone gets really worried. Everyone gets really, really worried. And as you can see, nobody's actually back to normal in any way. Here's another measure of the same thing. Banks run home to mama, the state. This is the LIBOR-TED spread. So there's the London Interbank borrowing rate. This is when big banks, the rate they borrow, they lend to each other. And the TED's the spread between that and the Treasury bill, so LIBOR-TED. So if you think that the Treasury bill is the most safe thing you can possibly have, then the spread between that and LIBOR basically is a measure of credit risk that's out there in the economy. So as you can see, everything's fine, everything's fine. Look how much this tracks exactly what we saw in the iTraxx. It's basically exactly the same. And everyone's still freaked out. And then here's the really fun one. And they still won't lend to each other or customers in the real economy after we bail them out. So this is interbank lending, basically yields on 3-month T-bills. So you've got very high yields because nobody wants them, right? You know, you just want to lend to make money. You're not going to sit around in 3-month T-bills basically watching your money do nothing. Well, actually the yields start to collapse. This bit here is really interesting. I should have bought a laser pointer. This is September the 18th last year when the government guaranteed payroll. Everyone went, oh, the crisis is over. And then by September 22nd, they went, no, it isn't. And then it fell off a cliff. So that's what a liquidity crunch looks like. And the basic problem is you have this housing bubble that pops. Everyone's loaded up in these things called mortgage bonds. Those mortgage bonds suddenly seem to be bad. Nobody looks at each other honestly and says, I've got lots of mortgage bonds. How about you? And you go, I've got tons too. Instead, everyone fears the worst and immediately liquidity contracts. So that's your first order mechanism of contraction. What does this do? Well, this creates what's called a DeLeveraging cycle, and this is when it gets really nasty. So for example, you're a bank, I'm a bank. I know that I've got a pile of crap on my books. I'm really sure you have too, and I know you're up to your neck in it, even though you're not admitting it. So what are you going to do? Well, you're going to try and get that stuff off your books. So you can see that the price is called mark-to-market pricing. You've got to do it at the end of the day or the end of the week. You've got to say how much this stuff's worth. You're buying it at 90. It's now showing 30. You know by the end of the week it's going to be worth 10. So what do? You fire sale it. You dump it. The minute you dump it, you made a loss. You've got to get something to cover that loss. So what do? You dump a good asset. So I look at your asset portfolio, what I think it is, and I look at yours, and I go, oh, what have I got? I better get in there first. If we all try and sell it first at the one time, what happens? Price collapses. So you cycle from asset to asset through different asset classes, trying to cover the losses, compounding the losses overall. It's a fantastic example of individually rational and collectively disastrous. So what we see here is, compared to the current downturn, America's last recession, 2000-2001, was relatively mild. You can see there in the first quarter of 2009, minus 6.3, and this is basically down to deleveraging. What happens? Well, unemployment goes up, because if you're deleveraging and suddenly companies' assets aren't worth anything, and then they can't raise capital and they can't get short-term funding because the credit markets have seized up and everyone thinks the economy is falling off a cliff, then what happens? What's the biggest fixed cost facing business? Labour. Historically, it's been between 50 and 60% across all the economies of the advanced world since the 1930s. And in fact, you can go even further back. It's usually around 50 to 60%. So you start shedding labour. Now, a lot of it, of course, in the boom times, has been built up as kind of unnecessary, cluttered, sort of adding fat onto the beast, as it will. But you actually start to cut into the bone. And when you cut to the bone, you start to hit into consumption. So households themselves are forced to deleverage. When everyone's on the upswing, it's fantastic. Look, let's just have more credit card debt. I'll pay it off. The value of my house in Simona is always going to go up, blah, blah, blah. And then suddenly, oh, it's not. And they do exactly what business does. They have to deleverage at the same time. So you've got the private sector in terms of businesses and also in terms of consumers doing exactly the same type of deleveraging and driving asset prices further down the floor. This, of course, hits consumption. So you can see the change there between the savings rate on the red line and personal consumption expenditures. Americans are actually saving. Why? Because they're deleveraging. They're not getting on more debt. They're trying to build up some kind of positive savings balance. I love that little thing at the bottom. Binge borrowing and falling asset prices drastically weaken consumption, which accounts for 67% of economic activity in the United States. 67%. That means you're spending 67 cents out of every dollar. And you're not saving at the same time. This creates an interesting problem. To stop this cycle, because the deleveraging cycle can't drive you all the way through the floor, what do governments do? They basically load up. So as the private sector delevers, the public sector levers up. And it puts a ceiling on the floor. Puts a ceiling on the floor. That's a really stupid phrase. It puts a floor under how far these things can go down. And you see this here in terms of the fiscal balance, of average of the fiscal balance of advanced economies. What was a fiscal balance? You remember the good times, right? You know, oh, look, it's the last stock market bubble. It's fantastic. Yes, we've got balanced budgets. Remember that one? United States, you had it for about 3 minutes, right? And then you said, oh, well, never mind, it's okay, the economy's growing, doesn't really matter. No, it's getting better, look, because after 9/11, we've got an easy money policy, and then things go up again, and everything's great, and then, honestly, it's the best of all possible worlds. Nassim Taleb is a lovely way of describing this. Imagine an x-axis and the y-axis, and on the x-axis you put number of days, and on the y-axis you put number of amount of food. And then you put a line straight up the middle and you call it the life of a turkey. So you just keep going and, you know, one Thanksgiving, suddenly it's off. And no amount of data in the time series will tell you that the guy's coming out not with grain one day, but with a big knife. It's the Black Swan, exactly what it is. So anyway, what happens here? Well, your future tax burden just went through the roof. So that's public debt of advanced economies, and you're going to have to pay that back whether you like it or not. Now, how did they actually do this? This is where it gets kind of interesting. Have a look at the United States and have a look at the United Kingdom. These are the two most heavily financialized economies. That is to say, 20% of GDP and 30% of gross value added is tied up in the financial sector. It's an incredibly important component in terms of value added. 1/3 of all value added in the economy comes from doing finance. So look at the US. How did they decide they were going to put a floor on this? Well, they did a lot with capital injections in comparison to others, but not so much in comparison to the United Kingdom. Asset purchases. If you look at the Fed's balance sheet, it basically does this. You've got lots and lots of assets in the Fed that it never used to hold. For example, lots of swap agreements for holding these toxic assets and so on and so forth. Now, this is only 2.3% of GDP. But how much is the GDP of the United States? 14 trillion. That's a lot of asset purchases just with 2% of GDP. The Brits, on the other hand, are only a $3 trillion economy. They're spending 13.8% of GDP on direct recapitalization of their banks. Up here, this is move along a bit, liquidity provision for the Americans, 41.9%. So just over 40% of $14 trillion has been thrown at the market in terms of liquidity provision. Why are you doing that? I'll get to that in a minute. And then United Kingdom, 51%. But the difference hangs on the asset purchases. The Americans look at this, and it's a crisis of liquidity. You saw the liquidity crisis, right? So you chuck liquidity at it, and that'll make things better. Only it doesn't. And it doesn't because if everyone's still nervous, nobody wants to lend to each other, no matter how much money's lying around there. This is why you get the mechanism that I'll be happy to talk about in the Q&A as to why there's a stock market boom at the moment, despite all the indicators going the other way. It's called treasury repos and the mother of all carry trades. Anyway, down here on the bottom, when you look at the Brits have no alternative but to try liquidity, but also to recapitalize, because their banks are in even worse shape than they are in the United States. So they become wards of court. Now, think about what a change this is. These are the light touch regulation countries. These are the ones where we know that markets can manage themselves, that moral hazard is all we have to worry about, so on and so forth. These are enormous commitments. If you'd said to anyone in any line of work in 2006 that this amount of money would be propping up the banking system, you would have got really, really good odds. And here we are. So why? Usual suspects. Everyone in Kate's class has just read Robert Shiller, so I'm not going to belabor this one. The subprime trigger. Could have happened with credit cards, could have happened with auto loans, could have happened with a whole bunch of things. But essentially what you have is a bunch of collateralized mortgages that are meant to be statistically independent from each other, so that if one bit goes down, the other bit doesn't go down too. Turns out, whoops, everything's totally correlated with each other, so when they go bang, the whole thing goes bang. I'll explain more about that shortly. Too loose monetary policy. This is basically after 9/11, Alan saying everyone needs to go out and shop. And I'll give you a credit card to do it because things are really cheap. Well, there's also something else. The more interesting part of this is what I call Walmart dollar recycling. And this is where China and the global economy fits into the picture. So think about this. If you look at the income distribution in the United States, it's hyperkurtotic. That is to say, it goes... Now, they've got a tiny little bit of people at the top basically taking up and producing most of the wealth that's there. And at the bottom of the income distribution, I'm sure if Jamie Galbraith was around, he would tell you this one ad nauseum. The bottom 40% of the income distribution hasn't had a real wage rise since 1979. Now, you tell this to Europeans, and they're like, what? I mean, why aren't they rioting in the streets? I mean, my God, this is incredible. I mean, how hasn't this happened? Well, at the same time that we began to financialize the economy and do various other things I'll talk about in a minute, we also brought China online. What's Walmart's slogan? What used to be Walmart's slogan? And the prices keep on falling. So if I have constant real wages and I have falling prices, what just happened to my real wage? Just went up without anybody ever giving me a pay rise. So we got in a really nice deal with the Chinese, whereby we got them to make real stuff, which we swapped for bits of paper bearing either 0 or 2%, T-bills or cash, which they then said, what are we doing with this? And then bought agency debt, things like, I don't know, really safe assets like Fannie, Freddie, you know, those sort of things. And then they brought them home, and as they're round-tripping this stuff through our economy, this is basically adding more and more money for us to then lend out at super cheap interest rates to this big bloated financial sector, so that everybody here has how many credit cards in your pocket on average? 15 years ago, you didn't have one. Fun, isn't it? But there were other things going on too. What someone in Kate's class mentioned, the excellent PBS documentary on the radio, the NPR documentary, The Giant Pool of Money. If you haven't listened to it, listen to it. It is a wonderful, very, very straightforward explanation, if you will, of the macroeconomics or the global economics behind this. And I must say that I share the interpretation. But I'll put a little twist on it. How many of you are going to go into finance when you leave here? If it's still around, you know. How many of you want to be workers in a nationalized industry? No? Nobody? You liars. Anyway, the real scandal with this, honestly, I'll get to this at the very end, is the diversion of talent. I mean, you know, we need to be engineering our way out of global warming and stuff, not making complex derivatives, but, you know, that's just me. I got a fetish for the real world I actually live in. Anyway, here's the problem. How many asset classes are there in the world? Different types of asset that are fundamentally different from each other if you're an investor. Two, tangible and intangible. Now break that down. I'll give you one to start with. Real estate is its own class. Give me another one. Stocks. Now, stocks, securities, money, bonds are all fungible within one class. So really you're just talking about financial paper assets. You got real estate. What else you got? Commodities. That's it. So your portfolio of choices is actually pretty limited when it comes to what you can do, particularly if you see stocks and bonds and everything as reciprocal instruments within a particular class of assets. So imagine the following. Imagine that you have that generic problem of cycling through asset classes, because one's got to be a hedge for the other. If one gets risky, the other one has to be your backup, right? And then in the 1980s, we decided to do a couple of things that are kind of unusual. That we decide that we don't like capital controls anymore. And we decide that the best way to make an economy grow is to liberalize the financial sector and to allow banks to do international mergers. We decide that the best way to do risk control is to allow very big banks to have very big sophisticated computer models so that their capital adequacy numbers drop the bigger the computer model they have for judging the risk. We decide that we don't want the state to do things like Social Security anymore, so we have 401ks. And the minute you do this, and you have a huge market in foreign exchange rate risk now because Bretton Woods is over, you don't have fixed exchange rates, you're floating, right? So suddenly the private sector, which was this tiny little thing in the 70s, picks up the market in exchange rate risk, pension risk, privatization, all these different processes that creates a giant pool of money that we call globalization. So it's global in a way that's never been before. And you've got sophisticated institutional investors that can use very, very high levels of leverage to make a buck. And they all have to make a buck because that's what they do. They're banks. Whether it's TIAA-CREF for teachers, whether it's a hedge fund for private investors, everyone is chasing a buck through the same three asset classes. What does that look like? Looks like this. There's the US and global stock market bubbles. As you can see, the Nikkei, which was the real bubble economy of the 1980s, collapses actually in this one's 1987, right, so there we go. 1990, 1991, Japan gets into trouble. I personally blame the release of Michael Crichton's terrible film Rising Sun. I think that piece of racist bullshit actually destroyed the Japanese economy. That's just me. If you've ever seen it, you'll know why, and it's truly, truly horrible. Particularly Sean Connery in it. It was the weirdest thing. Anyway, but what we do see here is, here's the British and American stock markets. Track that off historic value. It just doesn't work. Second, there's your housing bubble. Oh, look, Hong Kong, Japan, the ones that had a bubble and it popped. Look at everybody else. Look at Ireland. What's the difference between Iceland and Ireland? One letter in 6 weeks. Thus goes the joke. Britain, the United States, actually isn't even the worst offender. I mean, your housing bubble was huge, but look at these countries. Look at the rest of them. Australia, 300% of GDP is in mortgages. Yeah, it's bonkers. Basically means that every house in Sydney added together is worth a year of GDP. Oh yeah, that's rational. And then, once you've cycled from stock markets in 87 all the way through to 95, when you start to diversify into housing and you create a global housing market bubble, you can always then run into gold and oil and corn and rice. And the only thing is, remember a couple of years ago now, the rice price went up 80% in 10 months? And we're all saying, oh, it's Chinese demand, as if Chinese people were suddenly like, I want much more rice than I've ever had before. And in fact, I want more of everything. So actually, as an aside on this, I got into a lovely fight with John Gapper from the Financial Times, because he did this incredible piece about how oil bubble wasn't a bubble, and it was all about rational this, that, and the next thing. And I just wrote a nice letter that said, penetrating analysis, if it's a shortage of oil that causes the oil spike, I suppose then a shortage of housing caused the housing spike, and a shortage of share certificates caused the stock market spike, right? So he wrote me back an ad hominem that said, you're an idiot, and I wouldn't send my daughter to Johns Hopkins if your life depended on it. Then the market popped. So I sent him the stock price every month, the spot price of oil for 12 months, just to annoy him. He never responded. See, I don't get paid enough not to have fun. I mean, that's basically it. So. And then you put these things together, you find out that one bubble led to another. So basically, your green line is your housing bubble, really beginning to pick up, take 5 years off this because it goes up to 2013 again, picking up really in about 1995. You've got your stock market bubble picking up way before that in 87, and you've got a commodities bubble as the other two begin to deflate, really picking up just in the last 2 years. And then those markets are too small to absorb those volumes. So they go super high and then boom, right down. Now, here's a story that I really want to tell you because you don't get this one anywhere else. or very many places. I went out and did 30 interviews in London, New York, Washington, and Boston with all the people I could find who would talk to me who really were in charge when the shit hit the fan. All right, so everyone, Federal Reserve people, senior CDS traders, rating agencies, economists, the whole lot. And I just said to them one simple question. From your point of view, filter off, nothing's been recorded, I'm just taking notes. What happened? And I got this story about what I like to call endogenous risk. Because the idea is that none of this should happen because we can price risk. Because risk is a property of an asset. An asset is more or less risky. And if you have a diversified portfolio and you're looking at all the correct measures and so on and so forth in your hedge, then making a bank safe makes the system safe, because the system is nothing more than the aggregate of the risk portfolio of all the banks added together. So you look only at the micro and you forget about the macro. And this is why we were blindsided by what we now call systemic risk. Because for years we'd forgotten to look at it. Because if risk is the property of an asset, then risk is held by an asset holder. That asset holder is an institution or an individual, and if they're over-leveraged and go bust, that's their problem. But the system as a whole will not do this. It's incapable of doing it. So if you make the micro safe, the macro becomes safe. Here's why this isn't true. So the first guy that said this, and I got a few others, was a European central banker. He said, all this stuff about bonuses, forget about it. You could take all the bonuses that were awarded in the past 15 years, put them into a big pile, and it's 4% of what we just lost. So why bother going on about it? The greed, the whole lot. The real problem is what it does to risk. So remember the story I told you about all these institutional investors popping up in the 1980s. They all need to make a buck. Well, if you go to work for a bank, or if you go to work for a hedge fund, or you go to work for a pension fund or whatever, you're going to have the target to beat. You're going to have a benchmark. That benchmark will be an average of some kind across your industry or within your firm or whatever it is. Now, let's say you've got 3 sets of asset classes and everybody starts buying into one asset class. What's likely to happen to the relationship between the fundamental value of the asset and the expected price? Be a little bit of divergence as more and more people bid up the forward price, or at least the expectation that things will be more expensive in the forward price. Now, of course, rational expectations will tell you this shouldn't help, but at the same time, if you've ever been to Florida and seen all these condos, you'll know that, in fact, it does help, because you want to be on the upside of the bubble, and when it bursts, someone else can carry the can. You average it out, and everybody's neutral. Yeah, but you know what? On the upside, it's really positive, and on the downside, it's not. So you're in an industry, across a whole industry, where everyone's job is to make more money year on year. So how can you do that? Well, then you start to take on riskier assets in the asset class. Or you move your assets from one asset class to another. Or you use more leverage. Or you use more complex instruments that can give you more leverage. Because everyone has to be 8%, and then the benchmark's 8.25. And then it's 9, and then it's 10. And you have a moving average problem, not in one bank, across all banks. The super portfolio of risk is actually much, much more high than you actually think looking at the individual portfolios of risk according to the models in the banks. So that's problem number 1. Second one, the math doesn't work. And this is from one of the guys who basically designed most of the value at risk and other types of models that they use in Wall Street. A very senior guy, and said, well, you designed half this stuff. What do you mean the math doesn't work? He says, well, there's 2 levels it doesn't work. The first level is similar to what the guy told you about the bonuses. Because here's the problem. We're all using essentially similar models. It's called model homogeneity. So we're using essentially similar models to price similar assets that are all in an upswing. Well, if we do this all at once, we all think on an individual level that we've got a portfolio that is balanced, because I'm buying here, but I'm also hedging here. Well, so are you, and so are you, and so are you. So what's actually happening, again, is if you look across banks to the macro, the super portfolio of risk is becoming what's called tunneled. It's all sitting on one side. And what's happening here is you've got this long tail out here. This is Nassim Taleb, right? And you don't know what's going on there. You think you do. You look at your numbers and it tells you, oh, my VAR number's 4. That means on a 99% probability I'll only lose blah, blah, blah. And suddenly the world blows up and everyone loses 4 trillion. That's one way it doesn't work. Another way it doesn't work is the following. People game things, and I'll get down to that in a moment. Once you put a model out there in the world as a piece of technology, everyone will reverse engineer it. So the minute you announce a rule, human beings, being human, will try and get on the other side of it. Now, if the world is truly an engineering problem with fixed parameters, you can't do that. But it's not, so you can. If we jump around in the distribution, if we don't have, as statisticians call it, an ergodic universe where sample paths always come back to the mean so that our models are accurate all the time, then you're making a lot of assumptions about the state of the world that may not be true. And if they're not, and you use mathematics to describe it that makes these assumptions explicit, you really are in trouble. Third, I thought you guys would like this one. Texas isn't Texas anymore. So the rating agencies got a lot of flack because of the conflict of interest and so on and so forth, right? Small beer. The really interesting part of the story is this one. So the really smart guys at Wall Street start to figure out that these things called mortgages are great because most people don't default. And you can kind of put them into three baskets. Well, let's call them the super senior, which is the mortgage of a tenured professor at an Ivy League university. I am never going to default on my mortgage unless I die, right? I mean, it's the only way it's going to happen. Or you can have senior, which would be like normal people in good jobs. And then you can have junior, which are people who are using collateral like boats with Fannie and Freddie to get a liar's loan to flip a condo. Now, they'll go bad. Some of them will go bad. None of them will go bad. The problem with holding the super senior is you'll get like a couple of basis points above LIBOR. You might as well just not do anything because they're useless assets. You don't make money on them unless you use massive amounts of leverage. The middle one's interesting. You can make money off of this, but you have to figure out how things are correlated together, which mortgages are going to go bad and which ones aren't. And then when you look at the crappy ones, you've got to figure out how much you could lose if all the crap goes bad at once. So you put all these together in one collateralized bond, junior, senior tranches, etc., and you start selling this stuff on. Now, how do you know this isn't going to blow up in your face? Well, you go to Texas, because the last big housing bust was here in the 1980s. And all of the models that everyone used was calibrated to the Texas data. And the Texas data said the worst thing that can happen in your junior tranche is a 20% loss with an 80% recovery rate. And when Texas went bad last time, New York stayed up, and so did California, because it was an independent market. People weren't buying condos. They weren't flipping vacation homes. They weren't doing liar's loan for their brother-in-law so they could get another mortgage so they could get yet another condo, etc., etc. This time they were, and none of that was in the model. There were even websites where you could go and become a junior person on someone's credit card in exchange for a fee to build up your FICO score. All of this stuff's going on, and it's not in the model. You're not calculating it. So you think the worst that's going to happen is a 20% loss. Then, the pièce de résistance. There isn't, apart from Texas, a separate data set against which you could do a long-run test, econometric test, about success and failure in mortgages. It just doesn't exist. But we've got one in corporate bonds. So why don't we use that? Because a bond's a bond, right? Well, no. Because in these bonds, what's happening is you're taking a little bit of Florida, and a little bit of Manhattan, and a shitload of Texas, and a boatload of Detroit, and you're wrapping it up, and you put it through a stress test in the model, and it looks good. And you say to the agencies, what do you think? And they're like, AAA. Great, I'll buy bond insurance as well to make sure that I can sell it to widows and orphans. You can see where we're going next. Gaming the rating agencies was easy. This is the truly shocking one. It's called correlation bombing. So I got access to a couple of very, very senior financial engineers, the one who make the really crazy products. And started chatting away, and it says, yeah, we did correlation bombs. What was that? So you know the whole thing about these things are not meant to be correlated, but they actually are correlated? We knew that. So what we did was we designed instruments, we designed tranched mortgage products that looked super safe, even though we knew they were filled with absolute garbage. We then sold them on to people who weren't thinking very much. You might have heard of them, Lehman, AIG, this sort of stuff. And then we bought CDS protection against them in massive amounts. So we built the bomb and lit the fuse and run away. What's this got to do with the rating agencies? Everyone's looking at the AAA rating. These guys could reverse engineer a triple rating out of a cornflakes box in an ashtray. Particularly because in 2004, what genius move did the government make in reply to complaints about rating agencies? They made the model transparent, at least for one of them, particularly the bond pricing model. So you knew the model. So you can just reverse that, engineer that model to get whatever you want out of that. Transparency is a good thing. Not when it breaks down the statistical independence that the rating relies upon. The ratings people told us this. Nobody wanted to listen because no one likes rating agencies. Finally, federal regulator. We just didn't think in terms of systemic risk. Well, why not? Well, basically, if a bank is safe and its numbers are safe and it's diversified, then if all banks are safe, the only thing you have to worry about is moral hazard. So if one bank gets over-levered, the one thing you don't do is you don't bail it out. Because if you do bail it out, that sends a signal to the other banks, then they'll all do it, and the next thing is you'll be in a bad place. Applying that logic, we let Bear Stearns go for $2 a share, we let Lehman go bankrupt, and suddenly we woke up to a world of really nasty systemic risk. Because it's not true that if you make an asset safe, you make the system safe. Because assets aren't inherently risky. There is nothing risky about a mortgage. Collateralize them all together, put them in a bullshit wrapper and sell them on to widows and orphans, you can do a lot of damage with a mortgage. But that's the intent of the person holding the instrument, not the instrument itself. Similar with complex derivatives. You leave people their own devices with private pensions, they'll invest in index funds. Index funds are great, make good money over 50 years, unless you happen to try to retire now. So what you want are complex things like life cycle funds. So when you're 30 years old, 90% risk, 10% hedge, and you move through. And then you can do this across the portfolio of different people in the fund, so you can really effectively balance risks. But that would be derivatives, right? They're dangerous, they're bad, we don't want them. It's an incredibly warped way of looking at the world. So we look at the micro, we blame the bank, we blame the instrument, and we forget the following. If everyone's portfolio of risk is tunneled and correlated, if you've got this much tail risk and you can't control for it, and you finally get slapped by an event like a mortgage crisis which causes a liquidity crunch, which causes a DeLeveraging cycle, you're completely unprepared to deal with the systemic consequences because you don't think systemically. Individual, 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 individual creates a systemic risk. None of those risks are priceable by banks' internal models. You don't show up in the data. Another great one I got was the world's not normal in 100 years of data. It's a great line, wonderful way of thinking about it. So, here's the depressing bit. Why all this means that no fundamental reforms should be likely to occur rather than unlikely to occur, forgive me. Two problems face regulators right now. The first one is regulating what you can rather than what you should. So let's think about some really big macro problems. So there's like Chinese-American imbalances, currency risk, all that stuff, right? Walmart recycling, IMF swaps to get rid of this risk, all this sort of stuff. It's all nonsense. These are political problems that will be worked out by structural mechanisms. You can't engineer a solution to massive global imbalances. It's not a regulatory problem. You can have all the commissions you want. You're not going to make a problem out of that one. Meso problems, institutional reforms. This is where the action really is, and a lot of action, if you look at the House Financial Services Committee, focuses on these in a piecemeal way. The British reforms are trying to do the same thing. Take two examples. Footprints. Banks shouldn't be too big because then they become not just too big to fail, but collectively too big to bail out. Totally true. So we should break them up. Give me a maximum leverage level. Give me a maximum footprint level of $500 billion. I'll build you a $5 trillion debt bank load in about 24 hours. Simply by going to the Cayman Islands, Russia, a whole bunch of different places that are not going to play ball. Second thing, leverage. Let's limit it. It is a great idea. Canada hasn't had a banking crisis. They had limited leverage at 20. But they also had very conservative fund matching strategies. They also had a very unique banking system and a series of institutions that made them uniquely Canadian, similar to the Swedes as well. You can't become Sweden overnight. You can put all the incentives in, and the really smart guys will immediately try and engineer a way around it. Micro problems, incentive solution. The whole system is pro-cyclical. Add all those mechanisms from bonuses to misleading mathematics to tranching to securitization, correlation bombing. Add all those things together, you've got a whole bunch of micro-level generated, non-priceable endogenous risk. The problem with the whole thing is the entire system's pro-cyclical. If you're a bank and you're sitting halfway up a bubble, you don't know it's a bubble, you just know things are good. Like any human being or like any government, you want to take credit for that. So it's due to our sound monetary policy or the marvelous stewardmanship of the Bank of Bob or whatever it happens to be. You don't want to admit that you're just basically pushing asset classes up and eventually there's going to be a bust on the other side. So the whole system is pro-cyclical, and you're Bob, and you say, I'm a bit worried about this. You know what? I don't think this is a good thing. We shouldn't be doing this. So what you're basically saying to your shareholders is the bank has to be overcapitalized and underperform. What happens to your job when you try and make that choice? Good night. And that's true for the CEO and for everybody on down, right the way through the organization. So all of these are problematic regulatory solutions. I've got some really clever ones, but I'm not going to tell you because it comes out at the end of the month. Some examples of what we do have on the table: a Consumer Product Safety Commission, the Brits and the Americans want this, a focus on instruments, the French in particular are obsessed by derivatives, because I think this actually speaks to French philosophy in general. They just hate micro. And if you ever noticed this, like they just hate everything in the micro, so everything's in the macro all the time. So instruments are by definition bad, because they're very small things. And you focus on positions as a proxy for risk. Well, here's why this doesn't work. If you have a safety commission, it doesn't deal with OTCs. That's 80% of the market. So you'll be able to regulate banks selling bad products like life insurance, and it won't do a damn thing for most of the things that you're meant to be worried about. It's also going to open avenues for creating AIGs, new ones, because I'm going to sit there with the really smart guy, and the really smart financial engineer is going to say, so what's the model the government uses for making things safe? You know, how do they decide what it is, what it isn't? Well, we'll look at some products that they legislate and what's safe and what's not. We'll figure out the characteristics of a safe instrument. And then I'll get a pile of really dangerous crap, and I'll tranche it and slice it and dice it and put it in a wrapper that makes it perfectly safe. And I'll sell it on to widows and orphans all over again. Focus on instruments. As I said, they're not born with original sin. What matters is, if you have a bunch of CDOs, CDSs, which are essentially an insurance contract against a firm failure with an embedded option. You get to sell it on to somebody else if you want for an income stream. And then on the other side, you have mortgages, which are pretty safe, generally speaking. They're safe and safe and safe. And you look at the past data, safe forever, nothing's happened. And then the world blows up. Why? Because market risk as a whole turns around the back of these instruments and turns these into weapons of mass destruction and these into incredible liabilities. That's the nature of the market risk as a whole changing, not the liquidity risk or the credit risk of the firm involved. It doesn't have anything to do with them. It's a macro property with a micro consequence. What this means is the whole thing the Europeans are trying to do, and the SEC is actually trying to do, is really problematic. Because you're going to look at all the people who are out there, all the different boxes they fit into. You're a hedge fund, you're this, that, that. Right, what's your leverage? What's your instruments? What are you doing? Full disclosure, the whole lot. Fabulous. Sounds good. First of all, is the informational problem. How do you process all that and actually gather all that in one place to a super regulator? But the more serious one is, I could have known all of the positions of every financial actor in 2008 and not generated the outcome we got in 2008. Because it's the way that these hidden risks, these endogenous mechanisms, the unpriceable risk in the micro level, produce a world that you can't price. That's why it's not about risk. That's why it's about a fundamental uncertainty. And the hubris that we've had is to produce a world in which we think we can swap one for the other, slice it, dice it, and pass along without any consequence. Doesn't work like that. The other thing you can do is build finance a giant bouncy castle to play in, and that's where we are now. So that's a bouncy castle, if anybody wants to see one. So this is what we've actually done in terms of regulatory reform to date. So first of all, you relax accountancy rules, so you can have mark to model rather than mark to market. Mark to model is also known as mark to whatever the hell you like. There are arguments for having a different type of fund because it's to do with the nature of, it's called a maturity mismatch, basically. If you're a life insurance company as a financial crisis, you don't suffer liquidity risk. Right? Because basically people are going to continue paying this and you're not really going to be affected by it. But if you have a regulation from Basel that says as a major financial institution you have to do mark-to-market pricing, as everybody else delevers, what happens to the value of your assets too? You're done, right? So there's an argument for not doing mark-to-market, but you've got to tie it to something like the maturity of the funding. Otherwise, everyone and their granny will turn around and say, but my assets are really worth a lot too. Well, if they were, we wouldn't be in a crisis. And what we did back in March was to relax the accountancy rules here to essentially revalue the assets to whatever the banks thought they were worth. So in other words, we didn't really have a crisis. You add endless liquidity or recapitalize, as we saw in the earlier table. You create, I like to call them the Goldilocks stress tests, because I don't even remember the stress test that we did. It was all the thing, oh, we're going to do the stress test with the bank. Well, they weren't too hot, and they weren't too cold, and they came right in the middle and raised $100 billion worth of capital. Why? Why did it? Not one bank out of the whole portfolio of American institutions was dead. Totally weird. And of course, we were meant to have these benchmarks. They were all stress tests to a 10% unemployment rate. We now have, if you use U6 as your indicator, a 17% unemployment rate. We are over 10% by the most doctrinated official figure. Are we doing the stress tests again? Is Tim running around saying we need to do it all again to check the bank's portfolios? Don't hold your breath. You can turn central banks into bad banks. Just really go have a look at the Federal Reserve's balance sheet. It makes amazingly interesting reading. You can pump the stock markets with repos, essentially. So you've got a liquidity crisis. You throw this liquidity at a bank, and the bank says, thanks, that saved us, that's great. And then you say, okay, but you can't have bonuses this year. And they go, really? Why don't you take your liquidity back? And then you say, but you're creating risk if you do that. And they say, we know, now can we have our bonuses? And you go, yeah, and you can have the money too. And then they say, but this money doesn't earn us anything. They say, I know, so give us it back, we'll give you some bonds, we'll do a swap. So you give them some treasury bills, like, phew, that's great, at least we're getting 3%. Oh no, the rate yield's falling. Can we get the money back? Yeah, sure, absolutely. Have even more. Why don't you buy distressed assets and just bid it all up? Oh, and by the way, you know the dollar's going to fall, right, because it's overvalued. So why don't you actually just short your own currency by essentially investing in foreign assets and then sell them on the upswing and then pay back the guy you borrowed the assets from? Fantastic. You have the mother of all short trades as you're going on. Whatever you do, don't actually limit leverage or compensation, because that would actually take on bankers' interests, and that's never going to happen. Admit that you really can't do anything at all and use insurance. When Gordon Brown came out last week with the whole idea of a Tobin tax, I was on the floor laughing. It's brilliant. Because Gordon for years has been basically Mr. Banker's expectations. Oh, well, finance is marvellous and we'll make money off that. And of course, London blew up. So the Tobin tax, I'm sure many of you know, was originally designed, or rather the original design of Tobin was to put sand in the wheels of finance to slow it down. It then became a way of promoting development because developing economies suffer more volatility and shocks from financial transactions than developed countries do. That didn't go anywhere. Now why do we need a Tobin tax? Because we can't get the banks to play nice. So what we're going to do is we're going to do a transaction tax to build up a multi-billion, if not multi-trillion-dollar fund globally for the next time they inevitably throw the thing off a cliff. I mean, what an admission. And then finally, what you can do is keep housing tied into the whole thing with life cycle earnings so you can start the machine all over again. Now, what did I learn? Nothing changes. Buy the senior debt of systemically important banks and hold it. Because they're too big to fail, too big to bail, and you basically have got the equivalent of treasury debt, only with a much bigger upside when you add gallons and gallons of liquidity. Be prepared for higher taxes and lower growth and higher interest rates, and all of that in the midst of greater returns to finance, because they're not going to give you anything else, and you've already paid for bailout one. And expect what I like to call performative reforms and judge, jury, justice. What do I mean by that? Well, we all know we were taking the financial crisis seriously when... Well, we've got Bernie, haven't we? That's that. Problem solved. And if you think that that's a cheap shot, you might care to try and remember who it was that symbolized the dot-com excess and who went to jail then. Martha made us safe last time, didn't she? So, basically, we spent a lot of money that we don't have on a bunch of firms that generate risks that they can't price, whilst using future taxpayers' money to make credit claims on other taxpayers' money that we couldn't even get yet because those people are not alive, waiting for a bust that we inevitably know is going to come. What's the gold price today?
11.30.
You wonder why? So there you go. Happy times.
I guess you don't provide any prescriptions on ways to potentially address this, but as in all casualties, it usually is a chain of events that leads to it.
Mm-hmm.
So isn't there a decent argument to say, if we remove even one of those, then this kind of misfortune would not happen again? So if we did limit leverage, then let's say the fuel, even though there might be liquidity around, then it can't fuel this kind of issue. So if we could even just tackle 2 or 3 of those, I mean, I think that's the idea of the government operating as in the interest of the public sector. If it can, with this tool, maybe handle a couple, 2 or 3 of those, eliminate this risk, maybe we don't have this cycle going forward.
I think that's... I actually am a member of a financial reform commission, so I'm giving you here my nihilistic impression, right? So basically, Kate said to me, look, just tell everybody what went wrong, give us the clearest version. So that's it. There are regulatory solutions, otherwise I wouldn't be on a regulation commission. So yes, I agree. But I would caution, and here's why I would caution, because it's the same problem with knowing positions and having margin limits and so on and so forth. It assumes that the system is programmable. That if you actually know all of the data of the past, you can basically develop some kind of search algorithm that could map out what the performance functions are and then map out what the possible states of the future are. And it's not clear to me that that's the case. So let's say we limit leverage, and somebody says, okay, then you limit leverage directly. You simply have a 1-to-20 ratio. But I'm going to use a whole bunch of derivative trades in a sequence. whereby that enables me to lever up, that enables me to lever up, that enables me to lever up. In principle, that can generate even more hidden risk than if it was just simply the old way of doing leverage. Now, this can be a counsel of despair, right, and I don't want it to be, but I think that we should be very careful about assuming that one or two things like this will actually make a great deal of difference. Because the thing that I came away with from all my interviews, I mean, really, I mean this quite sincerely, I met the smartest people I've ever met. I mean, these are geniuses, rocket scientists. I mean, the term is really, really true. And the incredible waste of talent that goes into like doing these things. But then again, you understand why. The rewards are so out of whack with any other branch of human endeavor. So if you have that as your incentive structure, it's really hard to regulate that. So that's what I would caution. Other than that, I would agree.
So your biggest regulation would actually be regulating the incentive structure?
Absolutely. Absolutely.
You had an opinion, I think, on the stock prices going up in the face of some other reality?
Yeah. Well, I gave a little bit of it there. Essentially, the arguments that I find convincing are the following. If you look again at what the Fed has been doing, is doing these enormous repurchasing agreements, whereby it's flooding the market with liquidity, swapping them out for bonds, swapping it back for more liquidity, taking it out with distressed assets. So essentially, we're cleaning their books and giving them dollars. And you have distressed assets, and you have benchmarks, and you have to do something. So what do? You buy them. So the very act of buying them pushes them up. If you're doing this in a context in which you know the dollar's going to go down, you can do an incredible carry trade on the whole economy. So you add these two things together, and that's the only thing that makes sense to me why every indicator is going down and the stock market's going up. It makes no sense.
So then the real question is, were you suggesting that people put 100% of their assets into those senior debt instruments? How bearish are you?
Well, it wouldn't be very bearish, actually. It would just be sensible, because we know that they're not going to fail, and we know that they're able to play lots of games with leverage. So if you bought Goldman 9 months ago, right? So I don't have a Series 7 or 9, so I'm not saying anything, right? But, you know, I would simply say that that's more than a joke when I say buy the senior debt and hold it, because it's probably a very safe asset with a great upside.
How much do you attribute the lack of transparency in the OTC derivative market for the actual financial freeze itself? Because my understanding was that nobody knew it was in anybody's books.
Right.
And what is being, I didn't hear you say much about transparency in that market in terms of the reforms. Is that something that's not going to be touched?
I really haven't figured this one out for myself, to be perfectly honest, because I believe that the following argument is false. Bullets don't kill people, people do. Right? I believe that's a false argument. If you give people guns, more people will die. I also believe that this is true. Butter knives do not commit murders. So if you saw a headline that said murder by butter knife, you'd be like, what? Wouldn't there have to be someone wielding the butter knife? And that's how I think about derivatives. Now, I know these are contradictory positions, because what should be true for one instrument is true for the other. But what I'm mainly concerned with, and what I think is more important, is if you cut up the world into credit risk, right, the risk that somebody won't pay you back, liquidity risk, your funding is going to dry up, both of which will land you in a bad position. These are risks that are unique to an institution. And certain institutions have more or less liquidity risk or credit risk. So hedge funds have enormous credit risk. Insurance pension funds have very little liquidity risk, et cetera, et cetera. Now, if you have a world in which you've got, basically you can have a pension fund that puts a hedge fund in the middle of it, that trades out of London and is regulated by the Insurance Commissioner of Pennsylvania, which is AIG. And you have hedge funds that actually do really sensible strategies and don't go bust. Then just focusing on the instruments, focusing on credit risk and liquidity risk and how this affects particular institutions, doesn't tell you about how market risk, the risk that all positions that you hold will change because other positions move against you, will interact with your instruments. So I know this is step by step, right? But essentially, I can be holding mortgages and they'll be safe for 100 years. And 101 years, they're not. Or I could be holding the short end of oil contracts because I'm bullish on airlines, right? And then let's say that Israel bombs Iran. I'm done. I'm just completely done at that point. Now, you could say, well, shouldn't you know that they're going to do it? Well, yeah, but then there's the whole thing about, this is why prediction markets are total nonsense. Prediction markets work great on binaries. So is Obama going to win the election? Well, more people say yes, so even more people say yes. So everybody says yes. You're just tracking opinion through the context of a market on a binary. The real trick is deviation times, is frequency times impact. So you've got to say there's not going to be a war. It's going to be how many people are going to be killed in the war. And that's the bit that's unpriceable. So if you're just focusing on instruments, you can do the binary calculation. Is this risky or is it not in the current context? If the context changes, you don't know the frequency times impact. You're going to blow up and you don't know it. So to me, it's the market risk behind the risk that the institutions themselves have that's important. Does that make sense?
Absolutely.
Yeah? Yeah? Because you're looking quizzical.
I guess this wasn't really my question necessarily.
Wasn't it? I thought it was.
I mean, it was. I guess the issue wasn't necessarily that OTC derivatives were bad, which seems to be.
Uh-huh.
You were giving me the feeling that.
Yes. Sorry, I thought that's what you were getting at.
No, I was saying.
I'll try it again.
Banks weren't. There was the irrational distrust of each other amongst banks because.
Oh, there's nothing irrational about it.
The distrust amongst banks because nobody could see these OTC derivatives.
Right.
So nobody knew whose liabilities were what.
But even if you could see them, you wouldn't know what they're worth because you don't know what your ones are worth.
But wouldn't it at least lead towards some sort of system of general, more better understanding?
Could lead to an even bigger panic. If I know that all the stuff that I had that was trading at 90 is now trading at 10, and I think you've got a book full of the same stuff, but I really don't know that, I might be willing to listen to somebody who says, no, really, Goldman's in a better position. If we had complete transparency and I could really see what's on your stuff and we've got mark-to-market positions, you can detonate the system in 30 minutes.
That's after the system's been built up like that, right?
Right. But then you get slammed by something that you don't see. Nobody's going to see a layman coming. It's the bit that's hidden.
Thank you for your talk on this today. There's a huge or growing trade in volume of Islamic financial institutions, and I was wondering if you could kind of give me your take on that, and in your opinion, how do these institutions play into the current financial situation?
I know very little about this, so I'll tell you the bit that I do know. I believe it is the case that Islamic finance has never had a bubble. Because if you don't charge interest, you can't get into leverage. And if you don't have leverage, you really can't get into trouble with complexity. So if you have leverage and complexity, you're always going to get bubbles as people cycle through these asset classes. You don't have this in Islamic finance. You have relationship banking, which also gives you incredibly good local knowledge. Now, does it give you a very deep and robust financial system where you can move capital around the world and so on and so forth? No. Does it mean you have, to quote the Hindu rate of growth, the Islamic rate of growth? Possibly. But you've got to average this stuff out. I mean, if you basically have 8% growth for a long time, or 4% growth for an even longer time, or 2% growth forever, and the 2% doesn't actually blow up and cost $4 trillion, then maybe the 2% solution is actually the one you want to be on. It's just that it takes forever to get to the same point that you would be on if you were getting an 8% rate of return. And the problem with human beings is we want it now. So I think it's a wonderful system. It's just a terrible system if you want to make incredible amounts of money out of it. And that's what finance is.
Two questions. One, are you short selling the US dollar? And two, is the US dollar losing status as a global reserve currency in 5 to 10 years?
Let me take the second one first because I don't reveal my trading positions. I would simply say that it's a wise man has many bank accounts in many currencies. That would be my answer to the first one. Because if you buy another currency, you're shorting the dollar. It's the easiest way to do it. The whole global imbalances thing, I think, is fascinating. So I was sitting at this Warwick Commission meeting with many people who know far more about this stuff than me, and this whole thing had just come up that the Chinese has suggested, along with the French, about basically taking the Chinese exchange rate risk of about $1 trillion, and then saying, oh, it's going to devalue, it's probably $1 trillion, that'd be terrible. If we shift out of the asset all at once, we'll bring about the very thing we're trying to avoid. It'll be mutually assured destruction or monetarily assured destruction. So let's put it in the IMF. So what we'll do is an overnight swap. We'll do this for SDRs. We won't trade them. It'll just liquidize the central bank holdings, and we put all the dollars in the IMF. And I put my hand up and said, I think there's a flaw with this. What's the IMF funded with? Dollars. So if you can hold exchange rate risk, if you have a population, you can tax. That's why you have bonds, debt, government debt, all this other. You take the stuff off and you stick it in an NGO that's funded with the same asset that you're worried about devaluing. My God, I've got a bridge in Brooklyn to sell you if you think that's a good idea. So there's no solution to that one. Now, 5 to 10 years. I used to think that the idea that there would be a very, very sharp and sudden decline in the dollar to be not really on the cards. But last month woke me up. Now, you have a multi-person, multi-level prisoner's dilemma going on. Because all you need is Delhi to buy gold at the same time as Korea decides they want to diversify out of T-bills. And everyone all at once runs for the exits. And there's nothing to stop it. There's no mechanism. So even though it would be collectively disastrous for all holders of all dollar-denominated assets to do this, there's an unpriceable risk that it could happen. So what's the hedge? Well, that's why gold is running so high, but there's only a limited supply. You can see why oil's going back up, even if in the developed economies of the West, growth hasn't returned yet. So there's people trying to hedge with different commodity products and indexes and actual raw commodities. Is it eventually going to shift? Yes, and it's going to be really difficult for the United States because it means we're going to have to consume less and save more. That's really the only way this is going to work. And it also means that we have to export things. And that's a real problem because we don't make anything anymore. 1/3 of our exports are what's called licensed end-user capital goods. You know what that is? Things that go bang or commercial airplanes. We don't make cars anybody else wants. The computers we make that other people want, like Macintosh, the profits are certainly remitted home, but they're not actually made here. In terms of what we do in the world, we do finance. It's 30% of gross value added. And nobody's buying mortgages. So there's something going to have to give in terms of this. But the problem is, for the Chinese in particular, and the East Asians in general, you built up all these reserves after 97 because you swore blind you were never going to go to the IMF again. Congratulations. Now you're sitting on a pile of unpriceable exchange rate risk. What are you going to do? Because if you dump it on the market, you blow up the only thing that will keep your exports going. I don't see a solution. I see very small steps and a risk that it can all go like that.
Do we have time for one more question? Jeff?
Maybe a short set of answers would suffice, but on the micro, meso, and macro, I haven't heard you talk about, on the micro side, whether there's a case for reinstituting some kind of division between risk-averse investors and risk-seeking investors. That would be on the micro side. On the meso side, if you address the derogation and lack of attention to balance sheets over the last 20 years or so. And on the macro side, I wonder if you could address the question of whether these new products, in fact, simply created too much money for the system to handle.
Short answers, yes. There's an interesting hypothesis, two interesting hypotheses that I can't prove. The first one is that complex finance adds to growth. You can only prove econometrically the negative, that it doesn't take away from growth. So therefore it must add to it. Well, no, but that's as good as we've got. So, hypothesis number one. Fact number one. If you invest, I used to be very skeptical of this thing called the real economy, because when you're actually going up in the global division of labor and China makes the stuff and we do the financing and the Brits do the advertising, who cares, right? You know, it doesn't make any difference. But when it goes down, suddenly all politics and regulatory solutions become local and you have to find your own way in the world, and it's a very different world. If you invest in, let's say, a lathe in a shoe factory, my brother makes shoes, right? Then you create an asset which self-amortizes its debt over time. If you buy a financial asset, there's no self-amortization. You simply use leverage to take the gain on the spread. So you create debt that cannot be amortized. That's really important, and it doesn't get talked about. And that's why the balance sheet problem with finance is twofold. Number one, it's private credit creation. We don't talk about it that way, but it really is. And you think about it, the private sector managed to lose $4 trillion. So far, central banks globally, in terms of real committed asset purchases, have levered up $2 trillion. $2 trillion's gone missing. I mean, where do you hide $2 trillion? It doesn't exactly fit under the bed. So what's going on here in terms of the arrangement between these? How come you managed to get $4 trillion out of this system in the first place? I remember Robert Sollow said to me years ago, and having the conversation, he said, yeah, I can figure this out. I buy my granddaughter a computer for her birthday. It's called a great thing that adds to growth. The government buys a computer, it's called a waste because government spending is wasteful. Doesn't it have exactly the same effect? So that would go some way towards that. Very quickly on this one, if you have, I'll probably do this in black, it's easier. On here you have desire for regulatory capture. How many rules you want. You don't want any rules. If you have here up as maturity of funding, you get a world that looks like this. And also sort of desire to holding risk. Hedge funds, commercial banks, investment banks, private capital, insurance, and then dead savings, I suppose you call it. These guys don't suffer from any type of liquidity risk. These guys suffer from massive liquidity risk. What you don't want is a world whereby insurance companies are holding the wrong type of risk and hedge funds are holding the wrong type of risk for them. You want to have a balance. When you have a global standard for regulation, basically you flatten this out. So that hedge funds count the same way as insurance funds, the same way as banks, etc., etc. The world's way too complex for a Glass-Steagall now. You can't simply take that and go safe, risky, or the other way around. So what you have to do is tie the maturity of the funding source to the risk exposure of the institution. And if you do that, and then institute mark-to-funding rather than mark-to-market, you can balance, and also then have counter-cyclical capital requirements to lean against the wind. You can do a lot to stabilize the ship. And it's not interventionist, it's not light touch, but it's very thorough. And it's relatively easy. You're an insurance fund, you don't get to operate a hedge fund. End of story. If you want to do that, take it off balance sheet, and then it becomes public, and then we'll regulate it as a hedge fund. Don't draw capital from the parent organization. These are relatively transparent, easy things to do. Just have to do them.
Okay, well, thank you. We're out of time.
Thank you.